Hello and welcome to Market Watch, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it's relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it's relied upon as any form of advice at all. It's just general in nature only. I'm going to go a little bit outside of what we normally talk about on Currency Point, and that's actually look at the bond market. I've been on this for probably the last 6 weeks, and will probably continue to be on it for most of 2021. It is becoming a very interesting trade. And the reason for that is that we have seen bond bears come out of hibernation with gusto. They are absolutely ramping up the whole idea that the reinflation trade globally is starting to get quite a lot of pressure behind it. That's going to really possibly move either the fiscal or the monetary side of policy to move against it. And that, I think, is what's really interesting in terms of what it is. And you know it's a bear market when JGBs, Japanese government bonds, are participating in the sell-off as well. Yields are getting steep. There's no doubt about that, particularly at the back end of the curve. Again, what you would expect when you see reflation and the possibility of rate rises happening. Why it's interesting from an FX point of view is that clearly it generates flow. You are going to get basically, normally in history anyway, we've seen this, that it starts at a base point being the complete risk-free rate, which most people would say is the US 10-year, and then they look for steepness from there. And that's probably what we're starting to see play out a little bit as well, because at the moment, the risk steepness are going in the risk areas, which you would expect, just places like Europe, places like here in Australia, and also in Canada, and also over in New Zealand. So watch that quite closely, because clearly what it also means is that when you use this as one of your base ideas to sort of garner momentum, you look for flow, and it's going to create a flow movement off the back of it, where that 10-year gap, whatever it might be, basically we normally try and say start neutral on the US dollar, because if you use the US 10-year as your base case, watch for the spreads and the widening of spreads between the US 10-year and whatever have you. So look at euro dollar, have a look at cable, have a look at Aussie US. They're showing you those signs that that steepening that's happening is giving you that opportunity. It's also one to be aware of that it means that you need to look at even things like dollar yen, something I don't normally talk about because it is quite a risky trade. Technically, it is showing that it's probably playing true. It tested an absolute, rock bottom support level that it broke in January last week and bounced off it. And dollar yen even looks like appreciating off the back of it. So it's an interesting one. That bond trade is certainly one that is really driving this principle with removal. You'll then, as I said, neutral on USD to follow which pair you want to get into as that steepening and widening of spreads happens. And it's an interesting trade to watch because clearly those bond bears are out there in force, and they're going to likely try and push this through as hard as they can for at least the short foreseeable future.